Welcome to Credit Exchange, your weekly podcast where we speak to the biggest newsmakers and news shapers in finance. I'm your host, Lisa Lee. This week, my guest is Ashok Bhatia, CIO and Global Head of Fixed Income at Neuberger, an investment management firm with more than $600 billion in AUM. He's here to help us unpack the biggest topics in financial markets right now: inflation, the Federal Reserve, the artificial intelligence spending spree, geopolitical issues such as the Iran war, and much more. Welcome, Ashok.
Hi, Lisa. It's great to be here with you.
Let's start with inflation. We've got some positive figures today on inflation. CPI, Consumer Price Index, looks like inflation is moderating, and the great fear that the war in Iran, oil prices might be stroking, and also the artificial intelligence spending spree, which we will talk about later, might be stroking inflation again. Perhaps not the case, and maybe the Fed might actually start cutting again?
Yeah, I think, there is more good news on the inflation front than I think is generally being appreciated. And, as you mentioned, we're recording this today. Core CPI came in at 0.2% for the month. That follows a 0.0% reading the previous month. And what that does is it places the last 12 months of core inflation is running at about a 2.5% annual rate. This is way lower than it was 3-4 years ago at the height of core inflation increases of around 6%. So there's already been a lot of improvement in it, but that 2.5% number, it's still a bit elevated from where the Fed, wants it to be at its 2% target. And, I think you take a step back, like what's going on in inflation and how do you reconcile this? What's driving inflation lower this year is weakness in rents, weakness in shelter, home prices, all the things that go into housing. There's some weakness in auto prices, services, which is really driven by wages. I think one thing that's also maybe underappreciated is wage gains for the average hourly earnings for U.S. workers is, in the low 3% annual rate. So it's pretty broad-based pressure in a lot of these inflation areas. Now, the challenge is, I think a lot of the things that like you and I deal with daily or weekly, grocery prices, energy prices, the Iran situation, those are elevated prices, and that's where some of the inflation is showing up. And because those are things we deal with daily, it tends to get, I think, a little bit more into the psyche and the angst about inflation compared to some of these things like a house. You may not interact with the housing market, every few years, if not a longer. And so that's driving, I think, a little bit of the difference between the actual numbers and sort of how we all are feeling about inflation.
Because that's really helpful to know, because I personally don't feel as though inflation is lower, because you're right, to your point, I go to the grocery store, I go to the restaurants, and all the things that I consume on a daily or weekly basis, it seems elevated. But what you're telling me is that the inflation is lowering for sort of the big ticket items, the things that you buy less frequently. But how about oil? How about energy prices?
Yeah, the thing, I think we can say about energy prices, or there's a few things. One is energy prices in the reading we just got, actually, we're seeing lower energy prices because remember, this war started at the end of February, early March. We saw the big spike of energy prices, then it came off and, it's been bouncing around a little bit. So we're always getting this a little bit on a delay from where energy and oil prices were. So this was actually a decent month for the contribution from energy prices. I think the most interesting and really the most important thing, though, is that we're not seeing this rise in energy or crude prices pass through into other areas. One of the things, and if we go back to 2022, when we came out of COVID, energy prices go up. We were seeing transmission into wages. You were seeing special bonuses for truck drivers. You were seeing that pass through into, and I'm sure we all remember, we were getting the FedEx, UPS surcharges. That's not going on this time around. So energy prices are remaining at the energy level, the gasoline, retail gasoline level, not really filtering into the
the
other.
broader economy and
Yeah.
just having a knock-on effect where it's pushing prices up and up and up. Oh, that's interesting to know. So do you think the Fed might be able to actually cut this year? Because it seemed before this print that perhaps that was off the table and maybe finally give what President Trump so desperately wants, which is interest rate cuts.
Yeah, there's a lot to unpack in that question. And, I would start by just saying, I think, what is the Fed going to do? So let's take, what is the bond market telling us the Fed is going to do, or what's the expectation? So, if I look at the bond market, 2-year interest rates this year have risen about 70 basis points, 10-year, 30-year interest rates about 40 basis points. And so the bond market is priced for the Fed to hike, 1.5 to 2 times. So we have hikes priced in. So the bond market is expecting the Fed to hike. So I think this inflation data, and we also, we had a weak payrolls number,
Yes, right.
or a relative, yeah.
Relatively weak, which I think was first indication that maybe the Fed might have more leeway than we thought.
Yeah. So I think it's a pretty, my view, our view is the data will cooperate with the Fed over the next few months, just like this employment data has and the inflation data, and the Fed will be on hold. I think to get the Fed to ease, we are going to have to see a pretty quick rise in the unemployment rate. Easing is going to take this inflation remaining behaved, but it's also going to require weakness in the labor market. And, I don't think we're really seeing that yet. There's, like, as you said, there's some hints in this last month's print that maybe some things are going on in the, in the labor market that we may see some more weakening, but I don't think we're quite there yet.
But if they start holding and cutting, I think one of the big questions is not just about inflation, but about Fed independence. We have Trump's nominee candidate, Kevin Warsh. Now he's the chair, and there's been questions about his independence. Do you think, perhaps ironically, because Trump wants and has telegraphed that he wants a rate cut, that gives Warsh less room to maneuver because he has to show the market that he's independent?
I think there's definitely a part of that. Yeah, I think it's one of those that, the more you ask for something, the less likely you may be to get it. And I think that is going on. I think Kevin Warsh, and, the last press conference was maybe not as artfully done as that he'll do the next time. But I think what he really wants is he doesn't want these Fed decisions to be A1 of the New York Times. He wants them to start to be on page A3 or A5. And I do think, and, I think the markets and all of us, right, we've gotten into this sort of environment or habit that the Fed determines our economic
Everything,
outcomes.
right? Mm-hmm.
Yeah. That this
and tea
Fed
leaving, reading parsing every single nuance, every single dot. That was how we understood where the market was going to go next and where the economy would go next. But you're right. It wasn't always this way.
Yeah. And it's also, I think the reality is whether the Fed moves the interest rate by 25 basis points here or there, what's happening with federal spending and fiscal policy, what's happening with private investment and AI investment. These things are driving economic outcomes a lot more than the Fed doing 25 basis points here or there. And I think Kevin Warsh really wants to rebalance, the psyche in a way that the Fed is not either the savior or the driver of how the economic outcomes that we are all going to experience. And, I personally think that's a good thing. It's going to be a bit of a journey. He's not going to be able to get through 4 years or 6 years without giving us a little bit more of his framework, but that'll come. And, it is interesting, like on the independence point, he had a couple of dissents. There's a hawkish wing right now on the Fed, and, he's going to have to navigate that. So I'm less worried about Fed independence, over the near term. And, President Trump may have some more appointments. We'll see how that goes. But I think the Fed independence, at least near term, those concerns are a little overblown by the market.
And ironically, I think even President Trump is speaking less and less about interest rates. For a while, he was so vocal about the fact that there was a policy error that the Fed needed to cut. It's almost as though once he put his own man there, he's quieted a little bit, letting him do the job and maybe giving time for Wall Street and the markets to gain confidence.
Yeah, I think that's exactly right. Totally accurate.
But like you said, maybe Kevin Warsh is fine, and maybe, he is independent, but doesn't mean just because you're independent, you don't make a policy error. So what are the probability of a policy error, and what would that look like to you right now?
So I think a policy error would be, aggressive hiking at this point. Like I said, I think the Fed will get through the end of the year without raising rates. I think if the Fed raised rates once, it's not going to be, the end all be all. But, if the Fed started taking the policy rate up 100 basis points, I think just given the growth and inflation dynamics, the market would conclude that is really not necessary. It would also probably, start putting real interest rates into more of a danger zone. It would probably have some repercussions for the dollar. So I think the policy error would be really aggressive hiking. The other flip side of it would be, the Fed easing prematurely and the market concluding they don't really care about inflation. But I think that's also, these are obviously making an error is not the base case for the Fed. So I think we're in a zone where the Fed, it's gonna skate through this, and I don't see a tail risk from the Fed at least developing short term.
Because it is interesting, because right after the financial crisis, the Fed became such a driver of the markets and, zero bound interest rates. And now, to your point, we've got like a war in Iran that's drive bigger, a fiscal spending, and also what we'll talk about later, this hyperscalers and the AI spending that's overwhelming almost everything. But let's talk about what you just mentioned right now, real yield, because the 30-year Treasury is above 5% right now. When the long-term Treasury is at that range, how does that limit what the Fed can do? And also, how does that impact what you think as you're investing? Because that is not a good place to be for the U.S. to have such high borrowing costs.
Yeah, I think it is. I think it is a risky place for us. I really agree with that. And the way I frame this is, look, this rise in interest rates we've seen this year. I think if you went and asked sort of maybe the average person, they'd say, "Oh yeah, rates are up because inflation is up." That is not accurate. If you look at the bond market and look at inflation break-evens, they're basically unchanged on the year. What's happened, and so the market's expectations for all of the movements in Fed pricing this year, the bond market's really relaxed about intermediate term 5 to 10-year inflation rates. It is just telling you there is not a problem. But what has happened is real interest rates. And, you mentioned, the post-crisis years when the Fed was at zero and long-term interest rates were 1% or something like that. The big change that happened in the bond market is real interest rates. So that's I'll use the 10-year. If the 10-year today is about 470, the market tells you inflation will be about 220. That's a 2.5% real yield. So that's up from, basically zero. And what history tells us is 2.5% real yield for a bond is okay. It's not super cheap, not expensive. It's probably a little bit on the cheap side. But history also tells us that if the real interest rate, again, 2.5%, gets up to 3% or above, 3 to 4%, that's when bad things start to happen to the economy, because at that point, if an economy is growing at, call it 2.5, and you think about the real cost of capital at 4, you're kind of upside down on that. And it's often when financial accidents and problems happen. So I think about what's going on in interest rates is this rise in real yields, and it's being driven because governments are spending a lot of money and there's a lot of demands for AI investment. And I think the long end is, as you said, it's dangerous because the U.S. is running a 6% budget deficit. Interest expense is our biggest cost. And I think what the bond market is doing or thinking about is like, we've always known the U.S. runs big deficits, but it's always been kind of like out there and far away. it's suddenly starting to feel like dealing with these issues are on a horizon that we need to invest on. And I think that's the danger, is that if this all continues, rising real yields, expansive deficits, that's the mix of danger for the bond market.
Because we really haven't seen the bond vigilante. Like last time they really actually mattered, I think it was in the 90s, like almost Clinton era you have to go back to. Yes, we had a little bit with Liz Truss in the UK, but that was so short-lived. It's like the lifespan of a lettuce, as they famously showed, right? Yes. And so is this the rise of the bond vigilante, saying that there just is too much fiscal debt, not just from the US, but globally? Look what's going on with Japan and the yen.
Yeah, I think that's exactly right. I think it is, and maybe it's the bond vigilantes waking up or starting to stir. But, the thing that's specific for the U.S. that is, like we run a trade deficit, we run a fiscal deficit. We need foreign capital. China is investing less in treasury government bonds. Japan, big partner, big investor in
big
bonds.
Buyer of treasuries.
Yeah. And we need foreigners to buy our securities. That is sort of the math of the whole system. And as you said, like, foreign investors are increasingly saying, hey, why don't I bring my money home? If you're a European, let's invest in defense or, just feelings about the US. And if you're a Japanese investor, the economics of bringing your money back and investing in Japan, they're more compelling today than they've been in 10 plus years. So those pressures specific to the US are like, we have to find other sources of capital, at the margin.
How do they do that? Because you're right, it's at the margins. It's not like the world is going on strike on the US Treasury. It's still attractive. But I've talked to so many foreign investors who said, if we can, we want to diversify. We want to go Europe, going to go Asia. We don't want to put all our eggs into the U.S. basket because it's not as reliable as we once thought.
We totally see that, in our business. Just one anecdote, our portfolio managers who manage our European strategies, they started going to Japan to talk about European strategies, I think 2 years ago. First time they'd been there in 10 years. First time there was that kind of interest and demand. And I see it with our European clients wanting to look at European strategies. So I think the way it gets resolved is twofold. One is, we get our U.S. interest rates to levels that is just super compelling for foreign investors to invest. Or second, it's going to be the U.S. household sector and the U.S. saver that ultimately puts more into fixed income. And that's a broad category. That's insurance companies, that's banks, that's households. But effectively, the U.S. has to finance more of ourselves than asking foreigners to do it.
Well, is that actually feasible? Because one hand, because you said both, one is the fiscal house, getting our house in order. I don't see this Congress, this president, or even whoever wins the next election, Democrat, Republican, trying to cut down spending. It's all governments right now seem to be spending. So it really might have to come from the consumer or from the private side, right? Do you see that happening? Do you see the yields are maybe high enough where people say, let's go into fixed income? Because at the same time, we're going to talk about this later, we've got this AI spending spree, and though that there's such euphoria around that, why would you want to invest in 30-year treasury when you can buy Google debt?
Yeah, we and I think that, anecdotally, but also sort of the data that tracks this, we're not seeing a big shift from the U.S. saver to fund our debt yet. So I think the answer there is that interest rates, and it's also related to stock market performance, aren't really attractive right now to move that capital. I do think, and there's a lot of negatives and risk. I do think, just maybe a moment on how this could all kind of play out in nicely, which is, and I think this is a bit the bet the administration is making with their set of policies, which is AI will drive higher growth. It will drive higher productivity. It will drive higher tax revenues. So if we just sort of hold the line on spending, we'll see a quick revenue expansion because of AI growth and productivity, and that stabilizes our situation. So it can get stabilized by lower spending, but faster growth also stabilizes it, and that is also a to be determined right now.
Growth masks a lot of ills. If we have the growth, it's going to be fine. But what if we do? Yeah, so we grow. But if we don't have the growth that we anticipate, because there is some inklings now that AI profitability will happen, but it might not happen at the pace and near term as we expect. And I think it's still to be determined, but you can make an argument for both at the moment. They will take a little bit longer than expected to pan out, or it could be like we could start seeing the returns really in the immediate term. But what if it does take longer? Then what's the option with real yields getting higher? Do we just go into a recession? Because to your point, I've read your paper, 3 to 5% real yield, and the economy starts choking off.
Yeah, I think, we're at levels we're seeing, the impact of rates. You're seeing, and interest rates are a blunt tool. You see it's driving, it's creating pressure on obviously in mortgage rates, on, refinancing, on housing activity. So it's impacting the sectors that, you'd expect it to. I think the challenge with interest rates right now is, and it's, you mentioned AI, you look at Microsoft and some of the companies that reported, their earnings recently, and it looks like the return on investment for, call it AI data centers, AI hyperscaler activities, it's 20 to 30%, at least right now. So if you're driving those kind of returns, it doesn't really matter if you, Microsoft, are paying 5%, 6%, or 7% for your debt. The returns are still there. So it is a little bit this question of getting rates high enough to start to impact other sectors. And I do think, my view, our view is that you start to see interest rates up another 50 basis points from here, 0.5%. That's going to get us into the zone. I would expect that it's going to have some negative feedback into risk assets, because you're starting to enter the zone where it just starts creeping out and impacting more and more sectors of the economy.
But let's shift to AI, because that's going to be if somebody's going to save us, at the same time, that will be AI, but it's also AI that's pulling capital away from other investments, right? Because it's almost like an insatiable need for capital. Almost $1 trillion is expected in IG bond issuance alone this year and next. And when you consider that they've also tapped private credit, and they're tapping euro dollars, and they're tapping dollars here, let's talk about how are we going to finance this? Is there enough capital in this world?
Yeah, I think I think there is enough capital in the world. But maybe I'll just start with a few observations. And I think just the point you made about the scale. One of the ways I like to articulate this is Oracle has more corporate debt in our bond market indices now than Citibank, which is really remarkable, I think, when you think about industrial company compared to a leveraged banking institution. These issuers, whether it's Microsoft, Google, Amazon, they've gone from irrelevant to the bond market to the biggest risk factors in 2 years. And so I do think, on the question of where's the money coming from, is there enough money out there? I think, first of all, the hyperscalers have a lot of cash flow, right? Microsoft, Oracle, Meta, Amazon, they all have these underlying businesses that throw off a lot of cash flow that allows them to borrow. So I think that's a positive to find money. And what we're really seeing in the bond market is I would say three, and there's a fourth coming now, of ways they're borrowing. One is these hyperscalers. So they're the Amazons, Microsofts, building data centers, issuing debt to take down chips and compute and et cetera. High quality credits. They're single A, double A, a lot of cash flow. I think you're going to get your money back from this set. We're also seeing then data center operators.
Yes,
so, somebody who builds, operates a data center, earns a fee for it. Maybe you've got leases from Amazon or Microsoft. They're doing bond issuances that is also high quality debt, and I think also very, very, very solid credit profiles. Then you have in the high yield market, you have more speculative developments. So these might be people that are building a data center without a tenant or a lower rated tenant. That's where we start to see the risk. Like, I think if something sort of ends up going wrong in this, you'll see it there first with a speculative development that doesn't get finished on time or doesn't get leased up at the rates people are expecting. And then the fourth thing, which is going to happen now, I think, is NVIDIA announcing that they want to do this chip financing. So, the analogy here is right now, the US bond market, like if you make a auto payment or even a cell phone payment, there's a good chance that that money that you pay monthly is finding its way into a bond that, we, an insurance company, somebody else owns it, the securitization process. There's going to be, we think, a development of that with the collateral being chips. And that will be another way of getting capital. So, bond issuance, we've seen less demand for some of the hyperscaler debt, but it's been
wide
really
now. The spread is wide now because I hear it's just some indigestions. There's so much supply coming.
Yes. And so, as you said, we've seen some widening of spreads, but deals are still getting done. And, my view is the market and, the market will find a way to suck out the capital that's needed for this. It might cost a little bit more, might not be the ideal structure, but, you started, the question with, it is a really big change. We're no longer like if we did this podcast 2 years ago, we would have probably been talking about excess savings and dearth of investment activities. And now we're in this world where the private sector needs investment capital and a lot of it. At the same time, governments need capital to fund their budget deficits. Right? And we got both going on.
But let's talk about NVIDIA, because that's something is fascinating. It happened this week. And that is that they have this new partnership with some of the biggest names in private credit. You've got Apollo, Blackstone, BlackRock, Brookfield, KKR, and Goldman Sachs. And they're committing so far $500 billion to create sort of a new asset class, a new financing vehicle. Can you explain to me what's actually going on and also what this tells you about the market? Because this seems to me a little bit of like, okay, is this okay? Is this a indication of a bubble?
Yeah, I think the way I think about it is that it's an attempt to finance a very specific part of the value chain in all this. So the example, like if we lend to Microsoft, what are we lending against? We're lending against Microsoft Office, subscriptions and Xbox and all the things they do. And then we're also lending towards them buying chips, writing a frontier model, building or leasing a data center. Like there's a few different activities that we're financing. If you lend to a data center, what are you lending against? Typically, you have the collateral of the actual building and the infrastructure. You have something on the lease payments. So in this whole, value chain, you've got the model writing, you've got the chips, the energy, the infrastructure. And right now, a lot of the financing is kind of blended and you've got collateral against all these. I think what this is really attempting to do is say, look, the chips are a key component of it. That's what drives computing power and computing speed. So let's strip out. We're just going to lend against the chips and somebody else can go lend against the building and the electricity and all these other inputs. And it's kind of this fragmentation of the value chain. And it's an attempt to, extract, because the chips, have residual value and, you might lend against them for 2 or 3 years, but they can last 10 years. There's a lot of intricacies there. But I think at its core, it's about separating the value of the AI chain and financing it individually. And on the circular financing, it is certainly, in some ways, it does feel like kind of vendor financing or seller financing that NVIDIA is, using its cash flows and margins to provide cheap financing to people who want to buy the chips. And this is a total risk. Like you've got it with the chips. You've got it with, I think, reliance. Some companies are more reliant on Anthropic. Some are more reliant on OpenAI. Meta's doing its own strategy here. So there is a lot of circularity in this. And I do think that one of the risk factors, I think the risk factors are really, the revenues and the prices people can pay for tokens is a risk. Building construction delays is a risk. Open source versus frontier models, that's a risk. But one of them other is like, right now the market, I think, implicitly assumes that kind of Meta, OpenAI, Anthropic, Gemini, there's a lot of room for winners in this.
Yes. Mm-hmm.
Yeah, if it becomes a one or two company winner model, there's risk there as well.
So, but does this also change the calculus of how you invest in some of the neo cloud firms? So before, when I spoke to investors, they were like, we want to go after the hyperscalers because they are sturdier. We back hyperscalers. But if NVIDIA is providing this kind of financing with private credit firms, does that change how you look at, say, a CoreWeave?
Yeah, it actually, I think, improves the ability. Yeah, it improves the ability of a CoreWeave. I think Microsoft, when you kind of work through the math, like Microsoft and Google probably are going to be better off just doing their own financing of this, so where they can raise capital. But like an Oracle, a CoreWeave, some of the other names that, are a little less known, I think this will be an attractive source of financing for, just like you said, some of those names.
And so let's talk also, you are the global CIO, and there's so much to talk about that we've only talked about the US. So let's move very quickly onto the rest of the world. Where else do you want to invest into?
So I think, if we look at Europe, Europe's growing quite slowly. Inflation similar to the US. We don't think inflation's a concern there. And we've seen a hike out of the ECB this year. We think that'll be it. And we'll see an ECB on hold. The UK struggling with some of its fiscal issues. They're kind of at the forefront, a lot of the fiscal deficit issues. The one area we've liked and continue to like that's been a strong performer this year has been the emerging market space. And part of that has been tied to the commodity cycle. Part of it is they've been ahead of the whole inflation, disinflation cycle. And part of it is it's a way, I think, to diversify fixed income investments where you don't really have a lot of the AI exposure or some of the AI risks. It's seeping into other, European, Japanese markets, but it's really not in emerging markets. And so it's a way to diversify. And
that's interesting, right?
Yeah.
To get away from AI, because as exciting as AI is, we don't know whether it's overdone. And it's always good to diversify. So EM is a good diversification. And it's interesting. You mentioned commodities, and we haven't even talked about that. Earlier in the year, we had a war. We were talking about commodities all the time. Oil prices, also not just oil, but also fertilizers and all the things that you derive from oil. Is oil no longer a concern? Is the Strait of Hormuz something that we can ignore? Because what I'm hearing is, we went into the war with high oil reserve. We've sort of depleted that down. On the other hand, there are ships going through and the pipes are carrying more oil. So what say you about how worried you are that this war just continues on?
Yeah, I would say it's a risk. I think, what we learned is, the reason I think crude prices didn't get up to some of these, triple digit numbers that people
in the beginning, people were saying it was going to be a global depression, that airplanes wouldn't be flying, that people were not going to heat their homes. And none of that has materialized. Everyone's flying everywhere this summer.
Exactly, yeah. The airlines seem to be doing quite well. And I think it is, China actually cut its demand pretty quickly and strongly. We've seen that there is more ways, like whether it's gray markets, but crude is getting out. Some of it's the Saudi pipeline. Some of it is, gray market type of activity. And then the third, which you mentioned, which is the developed markets have drawn down their reserves, their strategic reserves quite a bit. So I do think China can take demand probably down a little bit more. Maybe there's still ways of getting oil out of through pipelines, and that is a structural thing, right? Everybody's building pipelines right now, and that's actually another source of capital needs for the world. So but the problem is those strategic reserves are pretty low. So I do think like this, the best case is that this sort of enters a phase of just stability. Crude prices stay around $80-85, and we kind of manage through. But if we see a spike, I would expect that this spike will probably be longer lasting than the last ones because we don't have those dampening factors as much.
And then where do you think you're going next? So, you have this freedom, take a little bit more risk. So what's the next few months, next year going to provide for you?
Well, one thing I'll just say is like, I think about the asset management business, quite simply, which is if we put up good investment results and, good returns, beat benchmarks, do well against our peer set, deliver what our clients want, water will find its own level and we will have a good business. So I think a lot of this is execution on the investment side. And if that happens, we'll all be fine. That said, a couple of things that are interesting to us on the bond side is, a stronger presence in the Middle East. We want to have fixed income investment professionals in Riyadh and Dubai, and we're working towards that as a near-term goal. We're talking about what our resourcing in Japan should be as clients come back to, as our Japanese clients at the margin want to invest a little less in the U.S. and a little more domestically. How do we serve those clients? And it's something that, our business has primarily, almost exclusively been in Japan, managing U.S. assets for those clients, not managing Japanese assets. And then, we have a pretty strong presence in China, and we've been committed to China. We remain committed to China. I think it's one of those things that, financially, commercially, wish it was more successful, but it gives us a lot of good information about what's going on in the world, in the market, and we continue to want to beef that presence up.
Great. Thank you so much. This is a great conversation. Feel like we've touched on so many things, and I hope you come back because this has been great.
No, Lisa, thanks. I really enjoyed chatting with you, and congratulations on your podcast and success.
Thank you.
And I would love to come back when it makes sense.
Great. And to our audience, thank you for joining us. We're on YouTube now, so do watch it there, subscribe, or follow us on Apple, Spotify, or wherever you get your podcast. This has been Lisa Lee.